I predicted the 2008 financial crisis when everyone on Wall Street called me crazy. I saw the subprime mortgage disaster coming years before it happened. I bet against the entire housing market and made hundreds of millions of dollars while the global financial system collapsed around me. And now I am telling you that what is coming next could make 2008 look like a minor correction. I am not trying to scare you. I am trying to prepare you. Because what I see happening right now with global currencies, with government debt levels, with central bank policies, it follows the same pattern I recognized before the housing crash. The same willful blindness, the same denial, the same assumption that the authorities have everything under control. They do not. They are making it worse. When I shorted the housing market in 2005, people thought I had lost my mind. My investors demanded their money back. My colleagues told me I was destroying my career. But I had done the research. I had read thousands of mortgage documents. I had analyzed the data. And the data told me that the entire system was built on a foundation of lies and fraud. I was not guessing. I was seeing what others refused to see. Today, the data is telling me something equally alarming about the future of paper currencies. The numbers do not lie. Government debt levels are at historic highs. Central banks have printed trillions of dollars out of thin air. Inflation has already begun to erode purchasing power, and the political will to address these problems does not exist. Every solution proposed by politicians involves more spending, more borrowing, more printing. Nobody is willing to take the painful steps necessary to restore fiscal sanity. This is why I believe physical assets are essential for protecting wealth in the years ahead. Not stocks, not bonds, not cryptocurrency. Physical assets that you can hold in your hands, assets that have value regardless of what happens to the dollar or the euro or the yen, assets that governments cannot print more of, assets that have preserved wealth through every currency crisis in human history. Today, I am going to share the 4 physical assets I would buy before a currency collapse. I am going to explain why each one matters. I am going to tell you exactly how I think about protecting wealth in an environment of monetary chaos. And I am going to give you the framework I use to analyze these risks so you can make your own decisions. Let me start by explaining what I mean by currency collapse. I am not necessarily talking about hyperinflation where the dollar becomes worthless overnight. That could happen, but it is the extreme scenario. What I am talking about is a sustained erosion of purchasing power that accelerates over time, where the dollar loses 30, 40, 50% of its value over a decade, where your savings buy less and less every year, where the standard of living for most Americans declines even as the government tells you inflation is under control. This is not hypothetical. This is already happening. Since 2020, the dollar has lost roughly 20% of its purchasing power. The things you buy every day, food, gas, housing, healthcare, have gone up dramatically in price. The government inflation statistics say inflation is coming down, but anyone who actually buys things knows that prices are much higher than they were a few years ago, and they are not coming back down. The reason is simple. The government has created trillions of dollars out of nothing. In response to the 2008 crisis, the Federal Reserve printed trillions. In response to the pandemic, they printed trillions more. The federal debt has exploded from about $10 trillion in 2008 to over $34 trillion today. That is not a typo. $34 trillion. And it is growing by trillions more every year. This debt can never be repaid in any conventional sense. The numbers are simply too large. The only way out is inflation. The government will pay its debts with dollars that are worth less and less. This is a stealth default. Instead of explicitly defaulting on bonds, they pay them back with currency that buys a fraction of what it did when the debt was incurred. Bondholders get their nominal return, but their real purchasing power is destroyed. This is why paper assets are dangerous in this environment. Stocks can lose value, bonds can lose value, cash definitely loses value to inflation. Even real estate, while better than paper assets, can be taxed, regulated, and in extreme scenarios, confiscated. The only assets that provide true protection are physical assets that you possess directly, assets that do not depend on someone else's promise, assets that have intrinsic value. The first physical asset I would buy before a currency collapse is gold. Real Physical gold that you hold in your own possession. Not gold ETFs, not gold mining stocks, not gold certificates. Physical gold coins or bars that you can see and touch and store securely. Gold has been money for over 5,000 years. Every civilization in human history has recognized gold as valuable. It does not corrode. It does not rust. It is rare enough to be valuable, but common enough to be practical for trade. An ounce of gold could buy a nice suit in ancient Rome, and an ounce of gold can buy a nice suit today. That is remarkable stability over 2,000 years. Why does gold hold its value? Because governments cannot print more of it. The supply of gold grows by about 1 to 2% per year from mining. That is it. Compare that to the money supply, which has grown by double digits in recent years. When the supply of money grows faster than the supply of gold, the price of gold in that currency rises. This is not speculation. This is basic economics. During the 1970s, when inflation was raging in the United States, gold went from $35 per ounce to over $800 per ounce. That is not because gold became more useful. It is because the dollar became less valuable. Gold was simply reflecting the destruction of purchasing power that was happening to paper currency. We are in a similar situation today. The money printing since 2008 has been unprecedented in scale. The fiscal deficits are unprecedented. The national debt is unprecedented. And the political unwillingness to address these problems is also unprecedented. All of this points to continued currency debasement, which points to higher gold prices. Now, I want to be clear about something. I do not view gold as an investment in the traditional sense. I do not buy gold to make money. I buy gold to preserve wealth. Gold does not pay dividends. It does not generate cash flow. It just sits there. But that is exactly the point. It sits there maintaining its purchasing power while paper currencies lose theirs. How much gold should you own? That depends on your situation, but I think having 5 to 15% of your net worth in physical gold is reasonable for most people. Enough to provide meaningful protection, but not so much that you are giving up significant returns from productive assets during normal times. Where should you store it? This is critical. Gold that you do not possess is not really your gold. If you store gold with a bank or a custodian, you are depending on their promises. In a true crisis, those promises may not be kept. Governments have confiscated gold before. Franklin Roosevelt did it in 1933. Banks have frozen accounts. Custodians have gone bankrupt. The only gold that is truly yours is gold that you hold. This creates practical challenges. You need secure storage. You need to protect against theft. You need to be discreet about your holdings. These are solvable problems, but they require thought and planning. A home safe bolted to the foundation, a safe deposit box in a stable jurisdiction, buried caches in secure locations. These are the kinds of solutions serious people use. The second physical asset I would buy before a currency collapse is silver. Silver shares many of gold's monetary properties, but has some unique characteristics that make it valuable in different scenarios. Silver has been used as money alongside gold throughout human history. The word for money in many languages derives from the word for silver. Unlike gold, silver also has significant industrial applications. It is used in electronics, solar panels, medical devices, and countless other products. This dual nature as both monetary metal and industrial commodity creates interesting dynamics. Silver is more volatile than gold. It tends to fall more in downturns and rise more in upturns. During the 1970s inflation, silver went from about $2 per ounce to $50 per ounce. That is a 25 times increase compared to gold's roughly 20 times increase. Silver outperformed. In the bull market from 2001 to 2011, silver again outperformed gold percentage-wise. The gold to silver ratio is something I watch closely. Historically, this ratio has averaged around 50 to 60 ounces of silver per ounce of gold. At times of extreme market stress or monetary crisis, this ratio tends to compress as silver outperforms. Right now, the ratio is in the 80s, which suggests silver may be relatively cheap compared to gold. Silver has one practical advantage over gold for potential barter situations. It comes in smaller denominations of value. An ounce of gold is worth nearly $2,000. That is not practical for small transactions. An ounce of silver is worth around $25 to $30. Much more practical for everyday use if paper currency loses its function. The same storage considerations apply to silver as to gold, but with an additional challenge. Silver takes up much more space per dollar of value. $100,000 of gold fits in a small box. $100,000 of silver requires significant storage space. This is a practical consideration when deciding how to allocate between the two metals. I think owning both gold and silver makes sense. Gold for larger value preservation, and silver for its potential outperformance during monetary crises, plus its utility in smaller transactions. A reasonable ratio might be 2/3 gold and 1/3 silver by value, but this depends on your specific circumstances and expectations. The third physical asset I would buy before a currency collapse is productive agricultural land. Not land as a speculation on price appreciation. Land as a means of production that can generate real value regardless of what happens to the currency. Food is the ultimate necessity. People can survive without gold or silver. They cannot survive without food. In every currency crisis throughout history, food prices have skyrocketed. During hyperinflations, food becomes the primary concern for most families. Those who can produce food have real wealth. Those who cannot are at the mercy of markets and governments. I own farmland, significant amounts of it. Not because I expect land prices to go up, although they might. I own farmland because it produces food. It generates real output that has value no matter what happens to paper currency. If the dollar collapses, an acre of farmland still produces the same amount of corn or wheat or soybeans. That production has real value that cannot be inflated away. Agricultural land is also harder to confiscate than financial assets. Governments can freeze bank accounts with a keystroke. They can seize stocks and bonds. But farmland is physical. It is visible. It is harder to take without obvious conflict. Throughout history, land has been more resistant to government seizure than financial assets, though certainly not immune. The income from farmland also tends to rise with inflation. When food prices go up, farm revenues go up. This provides a natural hedge against currency debasement. You are not locked into a fixed nominal return like a bond. Your return floats with the real value of what the land produces. Now, farmland is not easy to acquire or manage. It requires significant capital. It requires either expertise or trusted management. It is illiquid and cannot be easily sold in a crisis. These are real drawbacks. But for those who can afford it and manage it, farmland provides a level of protection that few other assets can match. For those who cannot afford farmland directly, there are farmland investment funds and REITs that provide exposure. These are not as good as direct ownership because you are depending on intermediaries, but they are better than nothing. Just be aware of the counterparty risk. Water rights are increasingly important when evaluating agricultural land. In many parts of the world, water scarcity is becoming a critical issue. Land without reliable water access is much less valuable than land with secured water rights. When evaluating farmland, water is as important as soil quality. The fourth physical asset I would buy before a currency collapse might surprise you. It is not real estate in the traditional sense. It is not art or collectibles. It is something much more practical. Essential goods that you will need regardless of what happens to the economy. I am talking about stockpiling necessities. Food with long shelf life, water filtration and storage, medical supplies, tools, seeds, fuel storage where legal. The physical goods that allow you to survive and function even if supply chains break down or prices become unaffordable. This is not about being a survivalist or a prepper in the extreme sense. This is about basic prudence. During the pandemic, we saw how quickly store shelves can empty. We saw supply chain disruptions that made basic goods unavailable. We saw prices spike for essential items. That was a relatively mild disruption. A currency crisis could be far worse. Having 3 to 6 months of essential supplies on hand is not paranoid. It is sensible. The cost is modest relative to the protection it provides. And, unlike financial assets, these goods have immediate practical utility. Food you stockpile is food you will eventually eat anyway. You are just buying it in advance at today's prices, rather than tomorrow's higher prices. Think about the optionality this provides. If there is no crisis, you consume your supplies over time and rotate in fresh stock. You have lost nothing except perhaps a small amount of convenience. But if there is a crisis, you have supplies when others do not. You have time to assess the situation without panic. You have resources to help your family and community. The downside is minimal and the upside is significant. What specific goods should you stockpile? Foods that store well. Rice, beans, pasta, canned goods, freeze-dried foods. Water filtration capacity rather than just stored water, since stored water is limited but filtration capacity is renewable. Basic medical supplies. Prescription medications if possible with extra refills. First aid equipment. Tools for basic repairs and maintenance. Seeds for growing food if the crisis is extended. The specifics depend on your situation, but the principle is universal. Now let me talk about what I would not buy before a currency collapse, because understanding what to avoid is as important as knowing what to acquire. I would not buy cryptocurrency as a hedge against currency collapse. I know this is controversial. Many people view Bitcoin and other cryptocurrencies as digital gold, as protection against government currency debasement. I disagree. Cryptocurrency has no intrinsic value. It produces nothing. It is purely a speculative asset whose value depends entirely on other people being willing to pay more for it. That is not wealth preservation. That is speculation. In a true currency crisis, I have no confidence that cryptocurrency would retain value. It might, but it might also collapse to zero. There is no floor under it. More importantly, cryptocurrency depends on functioning technology infrastructure. It requires electricity. It requires internet access. It requires functioning exchanges. In a severe crisis, any of these could be disrupted. Physical assets do not have this vulnerability. Gold is gold whether the internet works or not. I am not saying cryptocurrency cannot go up in price. It clearly can. I am saying it is not a substitute for physical assets as protection against currency collapse. It is a speculative bet that might or might not pay off. Physical gold has a 5,000-year track record. Cryptocurrency has 15 years and has already experienced multiple crashes of 80 to 90%. I would also not buy real estate as my primary hedge against currency collapse. This might seem contradictory since I recommended agricultural land, but hear me out. Residential and commercial real estate have significant vulnerabilities that productive land does not. Real estate can be heavily taxed. In a fiscal crisis, governments desperate for revenue will look at real estate as an easy target. Property taxes can be raised dramatically. Special assessments can be imposed. The historical examples are numerous. Real estate owners are captive. They cannot move their property to avoid taxes. Real estate requires ongoing maintenance and expenses. You need to pay property taxes, insurance, utilities, repairs. In a severe economic crisis, these costs could become burdensome or impossible to maintain. Physical gold requires no ongoing expenses. It just sits there. Real estate depends on functioning legal systems to protect ownership. In a true crisis, property rights can be abrogated. Squatters can occupy properties. Courts can take years to resolve disputes. Physical possession of gold or silver does not have this vulnerability. Now, real estate can still make sense as part of a diversified portfolio, especially your primary residence, which provides utility regardless of financial returns. But I would not rely on real estate alone as protection against currency collapse. The vulnerabilities are too significant. Let me also address the timing question, because I know people want to know when to act. When will the currency collapse happen? Should you buy these assets now or wait? I do not know exactly when. Nobody does. The timing of financial crises is notoriously difficult to predict. I started shorting subprime mortgages in 2005 and did not see the crisis climax until 2008. 3 years of waiting and being wrong before being right. The market can remain irrational longer than you can remain solvent, as the saying goes. What I do know is that the current trajectory is unsustainable. Government debt is growing faster than the economy. Interest costs on that debt are exploding as rates have risen. Entitlement spending on Social Security and Medicare is set to increase dramatically as the population ages. There is no political will to cut spending or raise taxes enough to balance the budget. The only mathematical outcome is continued money printing and currency debasement. This is why I think acquiring physical assets now makes sense, even though the timing of any crisis is uncertain. The longer you wait, the more expensive these assets may become as others recognize the same risks. The earlier you act, the longer you may have to wait for the payoff. But the risk of acting early is modest compared to the risk of acting too late. Dollar cost averaging into physical assets is a reasonable approach. Buy some gold every month or every quarter. Acquire silver over time. Build your stockpiles gradually. This smooths out the timing risk and makes the process manageable. You do not have to do everything at once. Let me share some thoughts on the psychological aspects of preparing for currency collapse, because the mental preparation is as important as the financial preparation. First, you need to accept that the world can change dramatically and quickly. Most people assume that tomorrow will be much like today, that the system will continue functioning, that their government will protect them. This normalcy bias is deeply ingrained in human psychology. It is also dangerous. History is full of examples of rapid, dramatic changes that caught populations completely off guard. Currency crises, wars, revolutions, pandemics. These things happen. They will happen again. Second, you need to be willing to look foolish. When I was shorting the housing market, I looked like an idiot for years. My investors complained. My colleagues mocked me. The market kept going up while I kept betting it would collapse. Being early is indistinguishable from being wrong until suddenly it is not. If you acquire physical assets, and the crisis does not come for years, you will look paranoid. You need to be okay with that. Third, you need to balance preparation with living. I am not suggesting you dedicate your life to preparing for collapse. That would be miserable and probably unnecessary. What I am suggesting is reasonable precautions that provide protection without dominating your existence. Allocate a percentage of your wealth to physical assets. Build modest stockpiles. Then live your life. The goal is resilience, not obsession. Fourth, community matters. In a real crisis, isolated individuals are vulnerable. Communities with diverse skills and resources are resilient. Investing in relationships, in local networks, in community ties, is as important as acquiring physical assets. Gold cannot replace trust and cooperation. Let me talk about what a currency collapse might actually look like, because I think most people have unrealistic expectations in either direction. They either assume it cannot happen here, or they imagine apocalyptic scenarios with complete societal breakdown. The more likely scenario is something in between, a gradual then sudden loss of confidence in the currency, rising inflation that becomes difficult to control. Capital flight as people move money to safer currencies or assets, government responses that make things worse, like price controls or capital controls or wealth taxes, a significant decline in living standards for most people as their savings buy less and less. This is what happened in Argentina multiple times. In 1989 and again in 2001, the currency collapsed, banks froze accounts, people lost their savings. But society did not collapse completely. People adapted. Those who had prepared, who had hard assets, who had diversified outside the domestic currency, came through relatively well. Those who trusted the system lost everything. Similar stories played out in Zimbabwe, in Venezuela, in Weimar Germany, in countless other countries throughout history. Currency crises are not rare. They are a regular feature of monetary history. The United States has been relatively immune because of the dollar's reserve currency status. But that status is not guaranteed. It can erode over time, and once confidence is lost, it can disappear quickly. The reserve currency status itself creates vulnerabilities. Because the dollar is in demand globally, the U.S. has been able to run enormous deficits and print enormous amounts of money without immediate consequences. This has allowed the imbalances to grow far larger than they otherwise would. When the adjustment comes, it will be proportionally larger. Let me discuss the geopolitical dimensions of currency risk, because this is something that many people overlook. The global monetary system is changing. China and Russia are actively working to reduce dependence on the dollar. The BRICS nations are discussing alternative payment systems. Saudi Arabia is considering accepting other currencies for oil. These developments are gradual, but they represent a fundamental shift in the global financial order. For 70 years, the dollar has been the undisputed reserve currency of the world. Other countries hold dollars as reserves. International trade is conducted in dollars. This creates demand for dollars that supports their value even as the U.S. prints more. If that demand declines, the excess dollars come home. Inflation increases. The purchasing power of your savings decreases. I am not predicting the imminent collapse of dollar hegemony. These shifts take decades to play out. But the direction is clear. The dollar's dominance is eroding. The world is moving toward a multipolar monetary system. And in that transition, the dollar is likely to lose significant value relative to hard assets. This is another reason to own physical assets. They are not denominated in any currency. Gold is gold, whether it is priced in dollars, or yuan, or euros, or rubles. Farmland produces crops regardless of which currency is dominant. Physical goods retain utility no matter what happens to financial systems. This currency agnosticism is enormously valuable in an uncertain world. Let me bring this all together with a framework for thinking about wealth preservation in an uncertain environment. Start by understanding that the current system is fragile. Debt levels are unsustainable. Money printing has been unprecedented. The political system is unable to make difficult choices. This does not guarantee collapse, but it increases the probability significantly. Next, diversify across asset types and holding structures. Do not have all your wealth in any single form. Have some in physical assets. Have some in productive investments. Have some in different currencies if possible. Have some outside the banking system. Have some inside it for practical purposes. Diversification reduces the risk of total loss from any single scenario. Within physical assets, diversify as well. Gold and silver for monetary metals. Productive land if you can afford it. Essential goods for practical resilience. Each provides different types of protection in different scenarios. Maintain operational security. Do not advertise your preparations. Do not discuss your holdings publicly. In a crisis, those who are known to have resources become targets. Discretion is a form of protection. Stay informed but not obsessed. Follow the indicators of monetary stress. Watch inflation trends, debt levels, central bank policies, geopolitical developments, but do not let this monitoring consume your life. Make your preparations and then live normally while remaining alert. Be prepared to adapt. No plan survives contact with reality perfectly. The actual crisis, if it comes, will be different from what anyone predicts. The goal is resilience and optionality, not perfect prediction. Having physical assets gives you options. You can hold them through a crisis. You can sell them if the crisis does not materialize. You can use them for barter if necessary. Options are valuable precisely because the future is uncertain. Finally, remember that life goes on, even through crises. People live through the Great Depression. They live through hyperinflations. They live through wars and revolutions. Those who prepared had easier times than those who did not, but almost everyone survived. The goal is not to survive some apocalyptic scenario. The goal is to preserve your standard of living and protect your family through whatever challenges emerge. I want to close with a story from my experience during the 2008 financial crisis, a story that illustrates why I believe so strongly in preparation and physical assets. In 2007, I was certain that the housing market would collapse. I had done the analysis. I understood the fraud in the mortgage market. I knew it was coming, but the market kept going up. My short positions were losing money. My investors were demanding I close the trades. Everyone told me I was wrong. I had prepared for this. I had set up my fund structure to prevent investors from withdrawing easily. I had built cash reserves. I had the conviction to hold through the pain. When the collapse finally came in 2008, my fund made massive profits while most of Wall Street was burning. But here is the thing I remember most. During that crisis, the financial system came within hours of complete collapse. Banks were failing. The money markets froze. For a brief period, it was unclear whether ATMs would work, whether checks would clear, whether the basic infrastructure of modern finance would continue functioning. Those hours made a deep impression on me. The system is more fragile than people realize. The veneer of stability is thin. What took decades to build can unravel in days. And when it unravels, those who have prepared, who have physical assets, who have independence from the system, are the ones who can navigate the chaos. I do not know exactly what will happen in the coming years. No one does. But I know that the risks are real. I know that physical assets provide protection that paper assets cannot. I know that preparation costs little and provides enormous optionality, and I know that the time to prepare is before the crisis, not during it. The 4 physical assets I have discussed, gold, silver, productive land, and essential goods, are not get-rich-quick schemes. They are not exciting investments. They will not make you wealthy overnight, but they will preserve your wealth through chaos. They will provide security when the system fails. They will give you options when others have none. That is their value, not speculation, not returns. Security and optionality in an uncertain world. In my view, that is worth far more than a few percentage points of return in normal times. The choice is yours. You can trust the system and hope it holds together, or you can prepare for the possibility that it does not. I know which choice I have made. I have the physical assets. I have the preparation. I have the peace of mind that comes from knowing that whatever happens, I am ready. I hope you will make the same choice. Not out of fear, but out of prudence. Not out of pessimism, but out of realism. The warnings are there for those who choose to see them. The time to act is now, while you still can, while physical assets are still available, while the system still functions well enough to allow preparation. Do not wait until everyone else sees what you see. By then, it will be too late. The time to buy fire insurance is before the fire starts. The time to acquire physical assets is before the currency collapse begins. I learned that lesson the hard way in 2008. I hope you can learn it from my experience rather than your own painful losses. The opportunity is there. Take it. Now let me go deeper into each of these physical assets and share some additional insights that I think are critical for anyone serious about wealth preservation. On gold specifically, there are important distinctions between different forms that many people overlook. Bullion coins from recognized government mints, like American Eagles, Canadian Maple Leafs, or South African Krugerrands, command a premium over their gold content because of their recognizability and guaranteed purity. This premium is worth paying because in a crisis, you want assets that are immediately recognizable and trustworthy. Nobody wants to test the purity of an unknown bar when they are trying to complete a transaction. Bars from recognized refiners like PAMP, Credit Suisse, or the Perth Mint are also acceptable, but they are more commonly used for larger holdings because the premiums are lower per ounce. For most individual investors, coins in 1 ounce or fractional sizes make more sense for flexibility. There is also numismatic gold, coins that have value beyond their gold content because of rarity, historical significance, or collectability. I would avoid these entirely for wealth preservation purposes. The numismatic premium can disappear in a crisis when people only care about the metal content. You pay extra for something that may not matter when you need it most. Storage deserves more discussion. Home storage has the advantage of immediate access, but the disadvantage of theft risk. A quality safe, properly installed and concealed, provides reasonable protection. But safes can be broken into given enough time, and they can be a target if people know you have one. Discretion is essential. Safe deposit boxes at banks provide security, but have significant drawbacks. Banks can freeze access during crises. Governments can order banks to report or seize contents. You may not be able to access your gold exactly when you need it most. I would not rely on bank safe deposit boxes as my only storage solution. Private vault storage outside the banking system is an option in some jurisdictions. These facilities provide high security without the regulatory vulnerabilities of banks. The best ones are in jurisdictions with strong property rights and limited government overreach. Singapore, Switzerland, the Cayman Islands. But you are still trusting a third party, and access requires travel. Buried caches are the ultimate in security from seizure, but come with obvious practical challenges. You need to remember where things are buried. You need to protect against corrosion and water damage. You need to be able to access them when needed. This is an advanced strategy that requires careful planning. The best approach is probably some combination of these storage methods. Some gold at home for immediate access, some in a private vault for security, some possibly in a foreign jurisdiction for diversification. The exact mix depends on your circumstances and the total amount involved. Let me elaborate more on silver and its unique characteristics. Silver is actually consumed industrially, unlike gold, which is mostly hoarded and recycled. About 50% of silver demand comes from industrial applications. This creates an interesting dynamic. Industrial demand provides a floor under silver prices because it has genuine utility. But it also means that silver prices can be affected by economic conditions that impact industrial production. Solar panels are an increasingly important source of silver demand. Each panel uses about 20 grams of silver. As solar adoption grows globally, silver demand from this sector is growing significantly. Some analysts project that solar alone could consume a substantial portion of annual silver production within a decade. This industrial demand thesis is one reason I find silver compelling alongside gold. It is not purely a monetary metal dependent on sentiment. It has genuine utility that creates fundamental demand. In a currency crisis, this industrial demand might decline with economic activity, but it provides support that pure monetary assets lack. The silver market is also much smaller than the gold market, which creates the potential for more dramatic price moves. The entire silver market is worth perhaps 1/40th of the gold market. This means that relatively small amounts of money flowing into silver can move prices substantially. In a monetary panic where people rush to hard assets, silver could potentially outperform gold dramatically because of this smaller market size. The gold to silver ratio I mentioned earlier is worth understanding in more depth. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, when mined from the earth, the ratio is about 8 to 1. Silver is 8 times more common than gold in the earth's crust. In monetary history, the ratio was often fixed around 15 or 16 to 1. In the 20th century, the ratio has averaged around 50 or 60 to 1. Today it is in the high 70s or 80s. When the ratio is high, silver is relatively cheap compared to gold. When the ratio compresses, silver is outperforming. During the 1980s peak, the ratio got as low as 15 to 1. During the 2011 peak, it got to around 30 to 1. If the ratio were to compress again during a currency crisis, silver would deliver exceptional returns relative to gold. This is why owning both metals makes sense. Gold for stability and large value storage. Silver for potential outperformance and practical utility in smaller denominations. The combination provides both security and optionality. Let me expand on agricultural land and some considerations that I glossed over earlier. Location matters enormously for farmland. You want land in a region with reliable water, good soil, appropriate climate for your intended crops, and reasonable political stability. You also want land that is accessible, but not too close to major population centers that could become chaotic in a crisis. The Midwest of the United States has some of the best farmland in the world. Deep topsoil, reliable rainfall, established infrastructure, stable property rights. But it is also densely farmed and expensive. Other regions offer trade-offs. The South has longer growing seasons, but different soil characteristics. The Pacific Northwest has excellent conditions, but higher land prices. International locations can offer value, but come with political and access risks. Water rights are becoming increasingly critical. In the Western United States, water rights are often separate from land ownership and can be extremely valuable. Land without water rights may be nearly worthless for agriculture. Before purchasing any farmland, understand the water situation thoroughly. Where does the water come from? Is the source reliable? Are the rights secure? Can they be taken away? Soil quality varies enormously, even within small geographic areas. Get professional soil testing before purchasing. Understand the drainage, the pH, the nutrient content, the depth of topsoil. Poor soil can be improved over time, but it requires significant investment. Excellent soil provides immediate productivity. The business side of farming is complex. You need to either develop expertise yourself or hire professional management. Farm managers typically take a percentage of gross revenue often around 10%. This cuts into returns, but provides essential expertise for those who cannot manage land themselves. The alternative is leasing land to farmers, which provides income without management responsibility but also without control over farming practices. For those who cannot afford farmland directly, I mentioned farmland REITs and investment funds. These provide exposure to agricultural land without direct ownership. The largest publicly traded farmland REIT is Farmland Partners. There are also private funds that invest in farmland, though these typically require accredited investor status and have minimum investments. The drawback of these indirect approaches is counterparty risk. You own shares in a company that owns farmland, not the farmland itself. In a severe crisis, that company could face problems that affect your investment even if the underlying land retains value. Direct ownership eliminates this counterparty risk. Let me go deeper on the stockpiling of essential goods, because this is an area where practical knowledge matters enormously. Food storage requires understanding shelf life and rotation. White rice properly stored can last 20 to 30 years. Dried beans can last 20 years or more. Canned goods typically have a shelf life of 2 to 5 years, though they may remain edible longer. Freeze-dried foods in sealed containers can last 25 years or more. Honey essentially never spoils. Salt never spoils. The key is to store what you actually eat and rotate through your stock. Buy extra of foods you normally consume. Use the oldest items first and replace with fresh purchases. This way, your stockpile never goes bad because you are constantly refreshing it with normal consumption. Water storage is more challenging because water is heavy and bulky. 1 gallon per person per day is the minimum for survival, and more is needed for cooking and hygiene. For a family of 4, a 30-day supply is over 120 gallons. That takes significant space. Water can be stored in food-grade containers, but it should be rotated every 6 to 12 months. Water filtration provides a more scalable solution than stored water. A quality gravity-fed filter like a Burry can purify thousands of gallons from questionable sources. Combine this with knowledge of local water sources, streams, lakes, rainwater collection, and you have renewable access to clean water without massive storage requirements. Medical supplies are critical and often overlooked. Basic first aid supplies are obvious, but consider also antibiotics for fish, which are the same compounds used in human medicine and available without prescription, over-the-counter medications in quantity, prescription medications if you can get extra refills, medical reference books so you can treat common conditions without professional help. Tools for self-sufficiency deserve consideration. Basic hand tools for repairs, gardening tools for food production, sewing supplies for clothing repair. These low-cost items could become extremely valuable if supply chains break down. Seeds for growing food are valuable, but require knowledge to use effectively. Heirloom seeds that can be saved and replanted year after year are preferable to hybrid seeds that do not breed true. Learning basic gardening skills before you need them is wise preparation. Energy resilience is another consideration. Stored fuel for generators or vehicles, solar panels for renewable electricity, wood for heating if you have a wood stove. The ability to function without grid power could be essential in a severe crisis. Let me address some common objections and questions that people raise when I discuss these topics. Some people say that preparing for currency collapse is pessimistic or negative. I disagree. Buying insurance on your house is not pessimistic. It is prudent. You hope you never need it, but you have it just in case. Physical assets are the same. They are insurance against monetary instability. Having them does not mean you expect collapse. It means you are prepared if it happens. Some people say that the government would never let the currency collapse, that they would intervene to prevent it. But government intervention is often what causes currency problems in the first place. The Federal Reserve's money printing is government intervention. Deficit spending is government intervention. These interventions are what create the risk. More intervention is not the solution. Some people say that if things get bad enough for currency to collapse, nothing will help. Gold will not matter. Only survival skills and weapons will matter. This is too extreme. As I discussed, most currency crises are severe but survivable. They involve major economic disruption and wealth transfers, but not complete societal collapse. Physical assets are extremely valuable in these scenarios. They are less relevant in a true apocalypse, but true apocalypses are rare and hard to prepare for anyway. Some people say they cannot afford physical assets, that they are living paycheck to paycheck. I understand this situation, but even small amounts matter. Buying one silver coin per month is better than nothing. Building a 2-week food supply is better than no food supply. Starting small and building over time is a valid approach. Do not let perfect be the enemy of good. Some people ask about timing again, whether they should wait for better prices. As I said earlier, timing is impossible to predict. Dollar cost averaging smooths out timing risk. If you are waiting for the perfect moment, you may wait forever. Start now with what you can afford and build over time. Let me discuss the mental models I use for thinking about these risks. I think in terms of probabilities and consequences. What is the probability of various scenarios, and what are the consequences if they occur? A severe currency crisis in the next decade. I would put the probability at perhaps 20 to 30%. Not certain, but not negligible either. The consequences would be devastating for those unprepared. Major loss of purchasing power. Potential inability to access necessities. Severe decline in standard of living. Given these probabilities and consequences, how much should you allocate to preparation? I think about it like insurance. If there is a 20% chance of a major fire, how much would you pay for fire insurance? Probably quite a bit. The same logic applies to currency crisis preparation. A meaningful allocation to physical assets is appropriate given the probability and severity of the risk. The key insight is that the cost of preparation is low relative to the potential benefit. Physical gold and silver retain value in normal times. You can always sell them if you need cash. Stockpiled food is consumed anyway. Farmland generates income. These are not wasted investments if the crisis does not materialize. They are productive assets that also happen to provide crisis protection. Compare this to the cost of not preparing if a crisis does occur. Loss of lifetime savings, inability to provide for your family, dependence on government assistance that may or may not materialize. The asymmetry is stark. The cost of preparation is modest. The cost of not preparing could be catastrophic. This is how I thought about the subprime crisis. The cost of being wrong about shorting housing was limited. I would lose some money on the trades. The benefit of being right was enormous. I would make many times my investment. The asymmetry justified the position even though I was uncertain about timing. The same logic applies to physical assets. The cost of being early or wrong is limited. The benefit of being right is enormous. The asymmetry justifies action even in the face of uncertainty. Let me close with some thoughts on maintaining perspective. Preparing for currency collapse should not become an obsession or dominate your life. It is one risk among many. You still need to live, to work, to enjoy your family and friends, to pursue meaning and purpose beyond mere survival. The goal is resilience, not paranoia. A resilient person has prepared for various contingencies but does not live in fear. They have taken reasonable precautions and then gotten on with their lives. They are ready but not obsessed. I have spent decades thinking about risks and preparing for contingencies, but I also live a full life. I have interests beyond investing. I have relationships beyond business. I enjoy music and movies and good food. Preparation is a foundation that enables life, not a replacement for it. So take what I have shared today. Implement what makes sense for your situation. Acquire the physical assets that provide protection. Build the resilience that enables peace of mind. And then live your life fully, knowing that whatever comes, you are ready. The currency collapse may come next year or in 10 years or never. I do not know. What I know is that the risks are real, the preparation is prudent, and the cost of action is low relative to the cost of inaction. Make your choice accordingly. I have made mine. The 4 physical assets, gold, silver, productive land, and essential goods, are your foundation. Build on that foundation. Adapt to your circumstances. And face the future with confidence, knowing that you have done what you can to protect yourself and those you love. That is my message. That is what my analysis of the data tells me. That is the wisdom I have gained from decades of studying financial systems and their vulnerabilities. Take it for what it is worth and prepare accordingly. But before I finish, let me share some additional insights about the mechanics of currency crises that I think are important to understand. because knowing how these events unfold can help you prepare more effectively and recognize warning signs as they develop. Currency crises typically follow a predictable pattern. First, there is a long period of imbalances building up. Deficits grow, debt accumulates, money printing increases, but nothing seems to happen. The currency remains stable. Inflation remains moderate. People assume that because nothing bad has happened yet, nothing bad will happen. This is the dangerous phase where complacency builds. Second, there are early warning signs that most people ignore. Inflation starts to tick up. The central bank makes excuses. Government officials deny there is a problem. Smart money starts to move. Wealthy and connected individuals begin converting their paper assets to hard assets or foreign currencies. This phase can last months or years. Third, there is a trigger event. It could be a failed bond auction where the government cannot borrow at acceptable rates. It could be a bank failure that reveals weakness in the financial system. It could be a political crisis that undermines confidence in the government. It could be an external shock, like an oil embargo or a war. The specific trigger varies, but something catalyzes the move from slow deterioration to rapid collapse. Fourth, there is the panic phase. Confidence collapses rapidly. Everyone rushes to convert paper currency to hard assets simultaneously. Prices of real goods skyrocket. The currency plummets. Banks may freeze accounts. Capital controls may be imposed. This is the phase where those who have not prepared suffer the most. Fifth, there is stabilization and recovery. Eventually, the crisis burns itself out. A new monetary regime is established. Prices stabilize at much higher levels. The economy begins to function again, but wealth has been redistributed dramatically. Those who held paper assets lost. Those who held real assets preserved their wealth or even gained. Understanding this pattern helps you recognize where we are in the cycle and what to watch for. In my assessment, the United States is in the first and perhaps early second phase. The imbalances are building. The early warning signs are appearing. Inflation has spiked and remains elevated despite official claims of progress. Smart money is moving into hard assets. But the trigger event has not yet occurred. This means there is still time to prepare. But the window may be narrowing. As more people recognize the risks, the price of physical assets will rise. Gold has already increased substantially from its lows. Silver has been volatile, but trending higher. Farmland prices have increased significantly. Waiting too long may mean paying much higher prices or facing shortages of available supply. Let me also discuss the international dimension more thoroughly. In a currency crisis, those who have assets outside the domestic financial system have significant advantages. International diversification provides protection against domestic capital controls, asset freezes, and confiscation. Physical gold in a foreign vault is outside the reach of your home government. Farmland in another country provides income in a different currency. Bank accounts in stable foreign jurisdictions offer alternative access to funds. These international options are not available to everyone, but for those who can access them, they provide valuable diversification. The challenge is that international options require more complexity, more cost, and more expertise to implement properly. Foreign bank accounts have reporting requirements. International real estate involves unfamiliar legal systems. Foreign vault storage requires travel for access. These are not insurmountable obstacles, but they add friction. For most people, domestic physical assets provide the core protection: gold and silver in your possession, stockpiled supplies in your home, farmland in your region if you can afford it. These domestic options are simpler, cheaper, and more accessible. International options are a layer of additional protection for those with greater means and greater complexity tolerance. Let me address one more topic that I think is important: the social and political dynamics of currency crises. These events are not just financial. They are deeply disruptive to social order and political stability. Currency crises create winners and losers. Debtors benefit because they repay loans with devalued currency. Creditors lose because they are repaid with currency that buys less. Savers are destroyed. Asset owners are protected. Young people starting their careers may benefit from cheaper asset prices if they have income. retirees living on fixed incomes are devastated. These wealth transfers create social tension. People who played by the rules, who saved diligently, who trusted the system, see their lifetime of work evaporate. People who took on debt, who speculated on real assets, who did not trust the system, come out ahead. This feels deeply unfair, and it is. Currency crises are fundamentally unjust events that punish prudence and reward speculation. This social tension often manifests in political extremism. When the center fails, people turn to the margins. The Weimar hyperinflation contributed to the rise of Nazism in Germany. The Argentine crisis led to political turmoil and multiple government changes. The Venezuelan collapse produced authoritarianism and massive emigration. Currency crises are politically destabilizing. Understanding this helps you prepare not just financially but psychologically and socially. In a crisis, your community matters. Your relationships matter. Your ability to work with others matters. Pure financial preparation is not enough. You also need social capital, the trust and cooperation of people around you. This is why I mentioned earlier that community investment is as important as asset investment. Know your neighbors. Build relationships in your local area. Develop skills that are useful to others. Create networks of mutual support. These social assets are as valuable as gold in a crisis, maybe more so. Let me also spend a moment on what to do with physical assets during a crisis, because having them is one thing, using them effectively is another. Gold and silver should generally be held through a crisis, not sold immediately. In the panic phase, prices may spike dramatically as everyone rushes to safety. Selling too early leaves gains on the table. On the other hand, after stabilization, prices may decline as the acute crisis passes. Understanding the phase of the crisis helps optimize timing. For spending purposes, silver is more practical than gold due to smaller denominations, but direct barter with precious metals is actually rare in most currency crises. More commonly, a black market exchange rate develops between the local currency and stable foreign currencies or gold. You convert some metal to local currency as needed for transactions at favorable exchange rates that reflect the metal's true value. Stockpiled supplies should be conserved and supplemented. Use your supplies to avoid panic buying at inflated prices. But also, look for opportunities to acquire additional supplies when they become available. Supply disruptions are usually temporary. Markets eventually function again. Your stockpile bridges the gap until normal commerce resumes. Farmland continues producing through crises. In fact, food prices typically rise dramatically, making farmland more valuable. The challenge is holding on to it. Governments may impose taxes or requisition production. Squatters may attempt to occupy unused land. Active presence on and use of the land provides protection. Absentee ownership is riskier. Let me also touch on the recovery phase, because crises do end. Eventually, a new equilibrium is established. A new currency may be introduced. The economy stabilizes. Normal life resumes, although often at a lower standard of living than before. During recovery, those who preserved wealth through physical assets have enormous opportunities. Asset prices are typically depressed. Skilled labor is available. Competition is weakened because many businesses failed during the crisis. Those with capital to deploy can acquire assets cheaply and build businesses with reduced competition. This is when paper assets become valuable again. As stability returns, productive investments in stocks and real estate begin to make sense. The physical assets that protected you through the crisis can be converted to productive investments that grow your wealth in the recovery. The transition from crisis protection to recovery opportunity requires judgment and timing. Sell physical assets too early and you miss protection during the worst of the crisis. Hold them too long and you miss opportunities in the recovery. There is no formula for this. It requires assessment of conditions on the ground and willingness to act when the time seems right. I have walked you through a lot today. The reasons for concern about currency stability, the 4 physical assets that provide protection, the practical details of acquisition and storage, the dynamics of how crises unfold, the opportunities in the recovery phase. This is not comprehensive. Entire books could be written about each topic I have touched on, But I hope I have given you a framework for thinking about these issues and concrete actions you can take to protect yourself. The fundamental message is simple. The monetary system is fragile. Paper assets are vulnerable. Physical assets provide protection. The time to prepare is before the crisis, not during it. I have done my preparation. I have the gold and silver. I have the farmland. I have the supplies. I sleep well at night, knowing that whatever happens to paper currencies, my family is protected. You have the same opportunity. The information is available. The physical assets are available. The choice is yours. Make it wisely, and make it now, while you still can. The evidence is there for anyone willing to look. The debt levels, the money printing, the inflation, the political dysfunction, the historical patterns that repeat over and over throughout monetary history. This is not speculation. This is analysis of data and history. I was right about 2008. I am confident I am right about this. But whether I am right or wrong, the cost of preparation is low and the potential benefit is enormous. The asymmetry favors action. Take that action. Your future self will thank you.